Well, welcome back to another episode of Finance Uncut. On today's episode, we're going to discuss the Australian property market. Let's have a look at this article by Lucy Dean in Yahoo Finance. Sign Aussie homeowners are in trouble. The number of Australian homeowners struggling to cover their home loan has more than doubled since June as new mortgage rules leave borrowers in a bind. New data from the ABS found 11% of Australians who own a property had trouble paying their mortgage on their home or investment property in October, up from 5% in June. That's just over 5% across all households, which includes renters. Around $133 billion of home loans were on temporary deferrals as of 30th of September, or around 7.4% of all loans. However, the number of home loans being deferred has fallen by 70% since its peak, according to the ABA. It comes after fresh analysis in Mozo's Mortgage Prisoners report found that while 88% of borrowers would like to refinance, 45% are stuck due to fallen earnings. The analysis of 3,270 borrowers found the average mortgage holder could save $78,000 over the life of their loan by securing a better interest rate. The majority of mortgage holders, 64%, feel their mortgage is incredibly high. She said borrowers who were also eyeing the property market with concern. Mortgage holders seriously concerned about making repayments, it's only natural that they'd be nervous eyeing the housing market and hoping things don't slide. The double whammy of foreclosure and plummeting home value is a real concern for many, she said. Mozo defined mortgage prisoners as borrowers who, despite having met every repayment, are unable to get a better deal due to new affordability tests that make them unsuitable borrowers for other lenders. It found that 29% of borrowers who deferred had lost their job and 16% had their pay cut. The flow-on effect is many owner-occupied borrowers are now finding themselves falling into the mortgage prisoner category. Sad reality is borrowers who need competitive mortgage rates to stay financially afloat most likely to be mortgage prisoners. On top of the mortgage challenges, the ABS data found 10% of Australians reported problems in finding a job, up 6% in June. Across both the June and October periods, 4% of people surveyed revealed difficulty paying the rent or fears of eviction, and 3% reported involuntary job loss. So you can see here the numbers. So household members experienced one or more mortgage stress in the last 4 weeks is up, and DFA, Digital Finance Analytics, has now got their mortgage stress at record highs at over 40% of all households. And I believe they survey over 50,000 households, I think about 55,000 households to get their data. And you can see here that not able to get a job has jumped significantly from earlier in the year, April to June, almost doubled there. So definitely some difficult times ahead. But Australians are taking steps to mitigate some of the financial pain, with 1 in 7 homeowners having had their mortgage repayments deferred or reduced, and 1 in 13 renters having had their rent or deferred. And across both groups, 5% have had a bill or rate payment deferred or reduced. Struggling Australians have also dipped into their superannuation, with 1 in 8 rating their retirement savings. Nearly a quarter of those said they drew down on their super to cover mortgage or rent repayments, but the most common use of the super was to cover household bills and groceries. And that's the thing, is that's now coming to an end. Everyone's basically anyone that's going to take super out has already done so. A lot of the funds there have now been spent, so there isn't this surplus of funds that they've taken from super. We know that some of the government's JobKeeper, Job Seeker has started to unwind and continues to unwind at the end of this year, and then gone in March next year. The Home Builder Boost, which ends in a month's time at the end of this year, actually has been extended, but at a lower amount. So from 25,000 down to 15,000 for the first quarter of next year. But with all that being said, if we have a look at the private sector credit in Australia, it was flat in month in October, the same as a downwardly revised figure in the prior month. Housing credit growth slowed 0.3% versus 0.4% in September, while credit declined further for both personal use, down 0.7% versus negative 1%, and business down 0.3% compared to 0.4%. Through the year to October, private sector credit expanded by 1%. So we're hearing about this, in some segments of the media, a property boom, but the private sector credit isn't showing that. You can see that private sector credit month on month has been quite ordinary. And if we have a look over the last 25 years, you can see that we are basically at an all-time low in terms of private sector credit growth, and we're coming off that little base, but off that low base, and we've kind of plateaued since then. If we have a look at delinquencies in the US, so this is what's interesting. So if we go back and have a look at the GFC, the peak of the GFC delinquencies, which is 90 days in arrears, so 3 months. So what we read in this article was only 1 month, so in October, but it hit just over 10%, just over 10%. So mortgage holders are in a bit of trouble. Let's not sugarcoat it. Yes, everything's been well, it has been sugarcoated really with mortgage deferrals, and job keeper, job seeker, people taking funds out of super. One thing that doesn't get talked about a lot is businesses trading while insolvent. That ends in a month's time. So next year, if businesses are insolvent, they continue to trade, then those directors will be held liable. At the moment, that's not the case. And at the moment, you can't come after people who owe you money as well. So there's, everything's this big problem that we've got is being kicked down the road. And, if we've got these problems at extremely, just record low interest rates, okay, record low interest rates, and everyone focuses on, the repayments. Oh, look, if I go get a mortgage of XYZ, then the repayments on that are the same as what I could pay in rent. So therefore, I'm going to jump in. Okay, but that's at record low interest rates. What if we get CPI increases? What if inflation, which personally I expect it to do as the lockdowns end and that demand comes back with all that new currency units created, and once that demand comes back, supply chain. So we globalization, or every economic theory says that globalization is deflationary, and that they all admit that globalization has peaked, and now we're going back towards deglobalization, and so therefore that's inflationary. All the headwinds at the moment, or tailwinds, are on the inflation bandwagon. Yes, you can say that some demographics and whatnot are deflationary in some countries, but everything that I am seeing is inflationary, just around the corner, if not already now. So, what's going to happen with interest rates? Do we just let inflation go out of control? Yes, central banks have said that they're not going to raise rates in the next few years, and that they're happy for inflation to go above their target of that 2 to 3%. But if inflation gets out of control, then the central banks are going to have no choice but to start raising interest rates. And so these people who are jumping in now based on repayments, they better hope that interest rates stay low for the next 30 years. They get a 30-year mortgage, they better hope. We can have a look at wages. For the last 10 years, they've gone sideways, if not down. So, people say, oh, it doesn't matter about inflation or interest rates, my wages will go. Well, guess what? Wages haven't gone up over the last 10 years, they've gone down. Flat at best. So we've got some severe issues facing us, and people aren't paying attention to that. People aren't factoring in tomorrow. Um, let's have a look at yeah. So here, so wages and government benefits paid. Still, the majority of people's income is being paid through government benefits. This is not sustainable moving forward. This, JobKeeper, job seeker has started to unwind, and as we, you know, the end of next month, it continues to unwind, and by March, it's gone. Um, this is look, wages have picked up in blue, so it has improved from earlier in the year, but it's not back to where we were. And some reports say that unemployment will ultimately peak somewhere, and this is using ABS numbers. And you know what I think of the ABS? They think unemployment is going to peak somewhere between 9 and 15%. 9 and 15. And if that's the case, you can almost double that for Roy Morgan's data. Um, interesting that dwelling prices and housing credit used to kind of go hand in hand. Now, as we saw in the private sector credit growth, that's been slowing. Yet house prices have remained relatively uh, uh, elevated. So, where do we think that's going to go moving forward? Is housing credit next year going to expand, or is it going to contract? Uh, are we going to get mass immigration next year and a massive boon in housing credit growth? The government have extended the home builder grant out to March, but at a reduced 15,000. Is that going to entice? Basically, what we've done is we've pulled forward the first home buyer demand from next year and the year after, and we've put it into this little 6-month period. So, what's the demand beyond that as we've pulled that forward? These are the things that people aren't thinking about. And housing crashes. So, this is the other thing. We've been in this pervasive sickness lockdown or recession now for what, about 8 months, 9 months maybe. And people are like, well, hang on, property market hasn't crashed 30% yet. What's going on? Well, let's just have a look at all the other jurisdictions that did crash previously. You can see that it takes on average 6.2% for a housing crash from peak to trough. You can have a look at all these different. So England was the only one that really an outlier there, which took 1.5 years. You can see the total decline: 27% US, 55 in Ireland, 18, 35 in Japan, 35 in Spain. You can see the per annum. So the per annum average is 8.3% per annum. In Japan, if you want to have a look at Japan's housing market, it fell 3% a year, but over a longer time period. In the US, it was 5% a year. So housing doesn't fall off a cliff like the stock market, where it can fall 30% in a month or in weeks. Housing doesn't do that. Housing takes a lot longer to crash. Now, am I still bearish on the Australian housing market? Yes, I am. Moving out over the next 2 to 3 years, I am more bearish than I am bullish, put it that way. I think all the tailwinds that we've had for real estate over the last 20 years have come and have gone, and those tailwinds aren't there anymore. Interest rates have got as low as they can go. Globalization, mass immigration, all that's going to change moving forward, and there's not that headwind on interest rates. That tailwind on interest rates anymore. Interest rates have just about bottomed. Maybe they can go a little bit lower, but if the central banks start going into negative interest rate territory, the evidence says that credit creation or banks start having issues with issuing credit. and that becomes it doesn't work. So that's not the answer to the solution. Um, do I think, am I as bearish as I was earlier in the year? Probably not. But I do think that people should tread with caution. You're looking at buying real estate, especially first home buyers. There's nothing wrong with continuing to save up and to be prudent. That's what I would be doing if I was a first home buyer. I would be just being prudent, continuing to save, not being in a rush, because I do see more headwinds moving forward. But anyway, what do you guys think? Do you think I'm wrong? Do you think housing is about to boom in Australia over the next 2 to 3 years? Do you think housing's going to stay about the same, or do you think it's going to fall? How much? Who knows? No one knows. In fact, that's the one thing that from my studies I've realised is anyone that will tell you it's going to fall 10%, 20%, 30%, 40%, or go up 10%, 20%. Not one single person has been right in the last 20 years, going both ways, going up, going down. No one knows. So, yeah, love to see your comments. It's in the comments below. Once again, if you like this channel, like the content that I put out, please like, share, and subscribe to the channel. And I'll see you again on another episode of Finance Uncut.